And Ross, I mean, maybe this is a point that this stock isn't crazy right now because it's in the red after another share offering here. What's your take on how investors should be looking at Tesla, though? Obviously, this is one of the companies you've held for quite some time here. What's your take?
Well, obviously, Tesla is finally realizing the value that I think investors now see clearly, not only the opportunity, but their dominance in the EV market as well as in energy and battery storage. So there is now a complete perception shift of Tesla from a year ago, from probably one of the most hated companies I've ever owned to now one of the most loved companies I've ever owned. I mean, I literally had a discussion with a Tesla shareholder who has $10 million in Tesla, and that's 100% of his net worth. And I couldn't get him to sell one share. Okay. And he's like, I'm not selling anything no matter what you say. And I'm like, dude, you got $10 million. So that's the amount of passion that's behind Tesla. So they've executed perfectly, and the stock has moved to, I think, a full valuation. And now Tesla's doing the smart thing, raising money, putting the basically free money on their books at a very high price. And this solidifies Tesla's position forever as a leader in EV and battery. So it's sort of a great day for Tesla shareholders, and I expect a great future for Tesla, but I do think the stock is very stretched.
Yeah, when we talk about how stretched that is, let's not forget that it wasn't too long ago that even CEO Elon Musk was tweeting about how he thought that Tesla's price was too high. And that was around, what, 781?
Yeah, we had the same price target, actually. When Elon tweeted that, I thought that was where the stock should be. It was like, back then it was 750. So let's say it's 175. And I thought that was a reasonable tweet, and boy, investors are obviously seeing what we've seen the whole time, and they're seeing it in, the rose-colored glasses and we appreciate that, actually, as shareholders.
Yeah, I guess just to push back and really double down on the questioning here, I mean, would you say that if Tesla itself is coming out with the share offering now at this level, would you say it's safe to call a top here in Tesla?
No, I don't like to make those kind of predictions because they're usually wrong. So I would say this. A client just called me and was like, should we buy more Tesla? And I was like, look, I love Tesla, but my job isn't to buy stocks at the highest price ever. Okay. My job is to find value in these opportunities. And there is lots of opportunity in the stock market right now, but it's not in technology. And so technology is valued incredibly rich and maybe deservingly so, but as an investor, you're supposed to be like doing, finding value in the market, even if it's in technology.
Yeah.
So you got to put a pause here. That's why Tesla's selling stock. If Elon's selling stock, there's a reason.
Yep. Yeah, no, I mean, and we talk about even finding value in tech, that becomes the challenge since some of these stocks have run so high. Just one button on it, RBC reiterated its underperform rating on the stock yesterday, calling it fundamentally overvalued, but it did raise its price target from 170 a share to 290 a share. So that's something to keep in mind there. But I want to shift the conversation over to one of those other tech stocks. We were talking about Apple just a second ago. What's your take on maybe the valuation there and what we have planned ahead? Obviously, the next rollout of its iPhones, not just iPhone's going to be coming out, but also a HomePod speaker. You've got the watches rollout as well. What should investors be watching there in terms of what they have planned in the coming in the next launch?
So with Apple, that's our second biggest holding. And, I've written Apple for my whole life and I love the company, but it's the same thing. There has been very little real innovation in Apple recently, and they've really benefited greatly from the pandemic because we've all need our devices like life support now. And I've actually ordered more Apple products in the last couple of months than I've ever ordered just because of the need and the usage of my family. So I think they're in great shape, but I've been an Apple shareholder my whole life, and to pay 40 times earnings for a company that was trading at 15 times earnings for most of the last 5-10 years, it seems like, once again, it's just like Tesla, you're paying the highest price ever for this company. And yeah, maybe Apple will go higher over time. But once again, the job of an investor is to find value, not just get on the fastest riding horse and hope you don't get bucked off, because eventually you will. And so diversification is super important. We own these names and we're not selling. We've sold some of these names, but not a ton, but we're well diversified in our portfolios and in a very conservative position. So that's where I want to juxtapose. It's super important for investors to be cautious right now because there's so much risk in the market.
Well, let's talk a little bit more about that too, because we're talking about Apple. We'll see what happens. Bloomberg has reported they asked suppliers to build at least 75 million 5G iPhones for that product launch. That would be about the same that we saw last year's launch. So we'll see what happens, because that would seem to indicate demand still there. But you talk about the risks in some of these tech stocks. I just want to highlight Zoom as well, since that's one of the ones that's been most talked about in terms of the video conferencing service there. Shares were up almost as much as 50% today. They gave back a little bit of that in the session. But when you think about why these companies are getting so much attention, it's because they're showing growth. They made as much money in the last 3 months in the quarter as they did in all of last year. So, I mean, it's proving that they can run this business and run it well in a pandemic. So maybe that's why we're seeing so much attention given here. But given the upside move, I mean, is that another name here where you would say there's not enough value anymore?
Well, I didn't have a chance to buy enough Zoom because I thought it was expensive, before this move. So fortunately, we own a little bit of Zoom. But Zoom, I would argue, maybe isn't expensive, because Zoom, in my mind, is like Google now. So it's like people talk about Zooming like Google or Amazon. And so, it's kept my business run. Like, without Zoom, my company would be in a completely different position than we are today. I am grateful and thankful for Zoom. And we're customers of Zoom, and we signed up everybody in my firm, and the amount of innovation. So the real thing about Zoom that's so impressive is their execution. To grow 4 times as big in a year and execute pretty seamlessly is amazing. So great job to the Zoom team. So I would argue, if Zoom does $1 a share per quarter, $4 in a year, and it's growing like it is, and 100 times earnings, you're at 400. So Zoom isn't as crazy as maybe Tesla and Apple are right now, because I think Zoom can grow to the sky when you look at their education business and their corporate business. So I think Zoom's here to stay.
Well, real quick before we let you go, I mean, you're talking about diversification. Last time we chatted, you talked about some of these other names out there that might have a longer run recovery here, MGM being an example, some of those other casino stocks we've seen. I mean, what would you tell investors, and again, real quick, about that diversification and the opportunity that might be there in some of these other value names?
Yeah, and I think that's the rotation out of the digital names into physical names that have the best opportunities moving forward. So we're aggressively buying MGM, especially after the IAC investment. We think this is a great play on the recovery for a lot of reasons. A lot of people can drive to Vegas, so they're not 100% dependent on airlines. We think that the demand is there. Actually, half the country doesn't believe in COVID, so they're still out gambling and doing stuff. So we're perfectly happy to make money off people who are willing to get sick. So, it's an interesting opportunity, because I don't like airlines and I don't like cruise ships, but I like Disney in here and I like MGM. So those are our 2 physical plays right now. We've added a lot to MGM. We haven't added to Disney yet.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.